It's interesting. You and I had a chance to speak over the weekend about it, and you have an interesting take. One would think that Chinese investors would be upset about what is happening right now with the trade fight, but indeed, you may have discovered the opposite.
Well, I'll tell you, Brian, it will be one of those things I remember for the rest of my life, which is sitting down with a major investor at the very moment that the tariffs went into effect. And it precipitated a very interesting conversation. You know, when I was somewhat defensive or apologetic about the situation, the feedback I received from the investors in China was that they actually saw this as perhaps a positive for the nation. They see the pressure that is being applied by President Trump as also perhaps causing the government to have to reconsider some domestic policy. And indeed they have. The premier announced that he is supporting a tax cut to stimulate growth, and that on balance this could be a positive step forward for China as the United States applies pressure and forces more reform within the country.
You know, pardon my cynicism, but I would view that, Scott, as somebody that says, well, of course, that's what they are going to say because they don't want to show the weak hand.
Well, you know, it was interesting. The client went out of his way to remind me about the long and deep friendship between the Chinese people and the American people. He referred back to the Qin dynasty when the United States supported the open door policy to stop the partitioning of China by the European powers. He was grateful for the liberation of China at the end of the Second World War, and also referred to Dr. Kissinger and how the Americans have been a positive influence on China in terms of opening the country up and bringing about a lot of reform and progress. So, you know, people forget that, and I certainly did, that the Chinese middle class is larger than the entire population of the United States. And this is internally a power to be reckoned with. And so I think the middle class is looking for more reform. They're looking for better jobs. And they think that, that the administration, by putting pressure upon the government, actually could expedite some of those things.
Any indication from those comments or others, Scott, that the Chinese are going to cease buying U.S. Treasuries in the volume they have been and potentially spike interest rates?
No, I don't think so, Brian. I think the pattern that we've been seeing is that the central bank continues to basically reinvest their portfolio. But you know, the one thing they don't want to do at this point is drive down the value of the dollar, which would result from selling their treasury portfolio, because you know, the depreciation of the yuan since the first round of tariffs have done a lot to offset the impact domestically. And I think that the real wild card for us right now is not so much whether they retaliate with tariffs, but if they just decide to weaken the yuan further and essentially offset part of the impact that the tariff increase has on the domestic economy.
Well, yeah, we don't sell that much to China. I wonder, they don't have that much power on the tariff side necessarily. I mean, they can wound specific U.S. companies, no doubt. But do you believe that the weakening of the yuan, the Chinese currency that we have seen, is kind of a form of soft retaliation, if you will, that will continue?
I think so. I mean, I think that they don't see it as soft retaliation as much as they see it as a way to reduce the impact of our aggressive acts toward them. What's really interesting, Brian, is if there's not another round of tariffs here, you know, there's approximately $250 billion worth of goods now that are being tariffed. There are approximately another $300 billion which are not. If the yuan were, let's say, to devalue by 10%, those goods which don't have a tariff attached to them would become much more competitive. And the goods that do receive the tariff will have increased about 40% of the total tariff. So a net, a depreciation of the yuan could be positive for the Chinese economy. Now, Treasury has made it clear that they're not happy with a weaker yuan. But, I think the Chinese could say, look, you're forcing this on us by your aggressive acts toward us.
Our former colleague and now head of the National Economic Council, Larry Kudlow, saying something that I think every CNBC viewer already knew. The tariffs are going to be paid by the U.S. consumer. They're paid by U.S. companies, the U.S. government. That's going to trickle through. That is inflation, Scott. But yet you've got a trade fight that is coming in the face of what some fear is an already slowing economy. How does the Federal Reserve balance that scale? Maybe a slowing economy, but higher prices, in part because of tariffs. Does that lead to a rate hike or a rate cut?
Well, look, Brian, I think that the Federal Reserve right now is more concerned about the strength of the economy than they are about potential weakness. When we saw the first quarter GDP data, it surprised to the upside. When we got the employment data a week ago Friday, it was extremely strong. That was April employment data. That's second quarter. There's likely to be a consumption bounce back as a result of the inclement weather and the government shutdown in the first quarter. We'll get a gauge on that this week with retail sales. But right now, I think the Fed is saying to themselves, look, we can't really justify a rate reduction, even though inflation is soft, based upon how strong the economy is, because that's going to potentially feed into inflationary pressure. When you layer on top of that the tariff, which will cause an increase in prices, or either that or a decrease in commodity or operating margins for corporate America, then they have to consider the fact that this is going to show up in producer price data. This is going to show up in consumer data. And just as they're now saying that the soft patch in inflation may be transitory, they're probably going to spend some time trying to figure out if the increase in inflation from tariffs is also transitory. But I think where their focus is on the real economy.
But from everything you've seen, all the data you analyze, that big brain of yours, Scott, do you see the Fed on hold all year?
Brian, I've gone on record before that I think that there's a risk that they're going to raise rates in the fourth quarter. We got a lot of data between here and there, but I don't see a change in rates in either direction as imminent. The only reason I would see a sudden rate change would be if the financial markets began to spiral out of control as a result of the tariffs. And then the Fed might actually do what they did back during the Asian crisis and react by an emergency rate cut.
Any reason to own bonds here? People keep buying them, Scott. Yields keep going down.
Brian, it's interesting. Bonds look so expensive. I've always been an advocate that people should have some long duration, high quality bonds in their portfolio. That served our clients very well during this period. But to add to that exposure at this point, I think you're a little late coming to the party.